Well, welcome back, everyone. Thank you very much. And again, thank you to ITG for sponsoring lunch. We now have, I think, a very interesting, exciting panel navigating an increasingly complex trading environment. And, the title itself is I think, an understatement. It's a very, very difficult environment that the guys are operating in. And I certainly feel for them. It's an understatement, as I say, to say increasingly complex. But today we have with us Rizwan Awan from BMO Capital Markets. We have Andrew Jappi from Canaccord Financial Incorporated. We have Doug Clark from ITG Canada. And we have Thomas Kalafatis from our CIBC World Markets. And I'm going to ask the guys to introduce themselves and give a little bit of a background on their business. So with that, I will pass it over to Rizwan.
Thanks, Rob. You're good. Thanks. So, hi, everyone. I am Rizwan Awan. I run the program and electronic trading business at BMO Capital Markets. I've been in the industry for about 10, 12 years, and over the course of that time period, as many of you share the same thoughts as myself, I have seen the transition that we've gone through, the tremendous transition that we've gone through from essentially what was a single marketplace to this multiple marketplace environment. And, of course, the frustrations some of the frustrations that we all share in terms of the complexities that have been introduced to the marketplace.
My name is Andrew Jappi from Canaccord Financial. We're a large independent Canadian dealer. We also have a dealer in the United States, and we have a dealer in the UK and some small participation in Australia, Singapore. So we're principally in capital markets and retail, capital markets across the globe, and we're in retail in Canada and have recently acquired Collins Stewart Hall Point in the UK and in the United States.
Doug Clark, ITG Canada. ITG is a global electronic trading and data-related research firm. I run our what we call our liquidity research, which is anything from transaction cost analytics to index, ETF, and market structure type research.
Hi, Thomas Kalafatis. I'm with CIBC. I'm here representing our Prime Services Group, which encompasses securities lending, prime finance, as well as our electronic access business.
Terrific. Thank you, guys. Now, I mentioned it's an increasingly complex market. I don't envy your challenges. I know there's a lot of work to do. How are you seeing today's marketplace? I know that volumes have come off. How would you characterize today's market and the health of it? Pass it over to whoever would like to jump in.
I'll jump in on that, and I'll tell a quick story. I was out at one of Canada's biggest pension plans last Friday. Was sitting in a room with eight portfolio managers going over some market structure stuff, some TCA stuff, and their head of portfolio management said to me, "We no longer trade around our core positions anymore because we don't believe we can get the same quality of execution we used to get. We think we have significantly higher opportunity costs, and we no longer understand how the marketplace works." Unfortunately, whether you agree or disagree with them, that is the sentiment of at least a surprising number of portfolio managers out in Canada and a large percentage of the retail clients. Our marketplace no longer is easily accessible, easily understandable, and it probably doesn't reward the right behaviors.
Anyone else you've seen the same types of stuff?
Yeah, no, I would completely agree with Doug on that. It's the same sort of sentiment that we get from our clients going out and talking to them. Basically, the time and time again, the answer that we get back is that our marketplace is becoming far more complex than it has been in the past, and as a result, we're not really even sure whether we're getting the right execution or the best execution. And quite often, we basically have to sit there and explain the whole process to basically clients on exactly what goes on behind the scenes, as we find that a lot of our clients basically are not even aware of some of the complexities associated.
But some of you are operating quite effectively. All of you are operating effectively, but some are really introducing a lot of new ideas, new technologies, and new ways to deal with this new environment. Thomas, I know you have built a lot of infrastructure that's helping people navigate this complexity.
Yeah, I would agree with the comment that the markets are more complex. I think there are a number of reasons for that, and I think we'll address that during the panel, but I would fundamentally disagree with the assertion that the markets are somehow broken or inaccessible or people aren't able to participate in them. I think the Canadian markets are very well regulated, very well managed, and when you compare our capital market to any other capital market of its size, it punches well above its weight. And you can see that in the end-of-day volume, even if they have declined recently. You can see that in spread. You can see that in depth of market. You can see that in the number of issuers that are public. I believe the TSX has the second largest number of listed companies in the world. That wouldn't exist if you didn't have a well-functioning capital market. So when we talk about complexity, when we talk about problems to solve, we should start with what problem are we solving for. Mm-hmm. And I don't think we're solving for a broken market. I think the market is actually quite healthy and vibrant.
And Andrew, I know you bring your firm brings a lot of these companies to market, so you must be believers out on the West Coast now. What are your issuers saying? They must be believing in this marketplace.
I think I would actually agree that the marketplaces are unnecessarily complex, that there are some factors in our marketplace through our regulatory regime or anomalies we have in Canada that allow an inordinate amount of small ATS to survive where they, quite frankly, would not survive in Canada with a different rule set, with an inability to charge for data royalties. So, I do think the complexities are there. I don't think they're there because they add value to the people who I think we ultimately serve, which are the issuers and the investors, whether they be buy-side or retail.
Mm-hmm. So the participation in our marketplace has changed quite dramatically over years. We've seen it ebb and flow. A lot of people talk about high-frequency traders, but they're one participant in here. Can you point to one participant that's driving this increased complexity, or is it just the world as it evolves? I know we like to talk about high frequency, but they're one of many, I think.
I think that most of we'll use the word innovation and we'll use it loosely, that is going on in our market. The various marketplace offerings are aimed to cater towards the high frequency traders. And every time a marketplace tells you that they're reducing latency, ask them why. All the reductions in latency do are create further complexity. They skew what you're being rewarded for. They significantly alter the risk reward of fast delivery of orders. They start to reward those who have laser-like focus on market structure and complexity and networking, and they stop rewarding those who are valuing firms, who are running models, who are talking to management, who actually understand the companies that they're investing in. And it really becomes something like hockey. If you start to reward the guys that hook and clutch and grab, you end up with a very ugly sport. If you cut down on that and you start rewarding on the skill players, you end up with a beautiful sport. We have turned our hockey game into something like the New Jersey Devils played in the early part of this decade. And if that's what you want to watch, that's terrific. I would much rather watch Mario Lemieux and Wayne Gretzky going at it. That's not what we're seeing today.
Do the others agree here?
Yeah, that makes for a nice soundbite. When one says that we've actually stopped serving, incentivizing investors, it's just not true. It's not plain true. Human behavior will always seek profit, and there will always be investors in a free capital market like ours. And it's not as if people aren't buying and holding. Like this assertion that marketplaces are required to provide the incentives for investors to do fundamental analysis and fundamental trading is not true. In fact, one finds that when you're designing a marketplace, the hardest thing to find are the people who are actually providing the price of convenience. When I look at the lens of high-frequency trading, I don't actually look at it that way. I look at it as you've always had market makers, you've always had price takers. And market makers take an inordinate amount of risk relative to the type of trading they do. They need to be right over 80-90% of the time to come out come out ahead at the end of the day. They provide a free call and put option on everyone else's price taking. And the idea that two ships in a night, a buy order and a sell order, are going to magically meet without that market-making ability, without that price of convenience being priced by someone, is a fallacy. And marketplaces generated incentives to bring those people in. In the old world, that I think some of my industry colleagues would like to go back to, you actually had a less transparent market-making model. You had one on the New York floor where information rights were contained. You had one where on the NASDAQ gold dealer market, people would front-run their clients. The Canadian market always had a very fair, well-functioning, and very balanced perspective on rewarding market making, which is necessary to provide liquidity, and investing. And if we look at absolute measures of investment incentives, we would not have 2,500 public listed issuers and be the sixth largest market cap in the market in the world if we did not have a well-functioning capital market that provided both incentives for investors and for market makers. There's no other country in the world with our size that punches at that weight. And when you look at objective criteria, again, it's a very well-functioning marketplace.
I appreciate that. Susanna's in the front row. We're doing an ad campaign for our market makers. Did you write down all that stuff? Because there's a lot of good stuff. That's, you've said it much better than I have said it to Susanna in the past. What do you guys think?
Yeah, I mean, I don't see it as much as one camp or the other. I don't think the idea here is that it's black and white, high frequency or traditional guys. I mean, obviously there's a time and place and for all participants that collectively makes up this ecosystem. However, one of the points is that all the exchanges and ATSs are for-profit organizations. Obviously, they're going to do what's in the best interest of their shareholders, and in this case, happens to be maximizing profits. So it's not a charity that's being run. So when you prioritize your projects, you're going to basically go after the projects that have the highest ROI, the return on investment. So as a result, when there's competing projects, one project comes up where it's a high frequency trader that wants lower latency, can potentially give you an extra 10-15% volumes in your marketplace, versus another one that's very near and dear to my heart that I've been lobbying for. It's getting odd lots and market on close facility pushed through. While odd lots are probably not going to make up more than 20,000-30,000 shares a day, but as a participant, it's extremely important to me that functionality exists in the marketplace. Because it's not there, it's getting prioritized by other, it's taking other things are taking priority over it. We're having an issue getting this thing passed. So it's a relative scale based on what if we are going to have these competing interests, what interest trumps the other, and what's the underlying cause.
Well, that leads to an interesting question. I'll ask Andrew to start off. With competing priorities and a need to service all of the constituents in our marketplace, does the retail investor benefit by default? If we can concentrate on these greater issues at your level, does the retail investor benefit by default, or do they have to be dragged into the conversation as well?
So I will get to that question, but I guess the concern I have when we talk about high-frequency trading, and it was interesting to see the panel just before Kevin, where exchanges are under constant competition to try and find new revenue streams, pressed by competition to reduce trading rates. And one of the net new incentives for exchanges, even for the ATS in Canada, is co-location. And co-location is really the emphasis and the rationale as to why we have this foundation to allow HFTs to come in with really no investment thesis. They have no real idea as to what they're trading, whether it's a gold stock or whether it's an oil and gas stock. They have little to any risk because it's all managed in their algorithms. And they do have some very refined strategies. We could, from a statistical perspective, show that that's incredibly valuable to the marketplace. Personally, I don't see it as being valuable. I see it as being an interference in the marketplace that's existing in the fringes and the fabric of the marketplace we've created. I don't dispute that it's efficient. That doesn't mean to say it's good. So does it, where we find ourselves, does it advantage a retail trader or a retail investor? Sometimes. I would say generally probably not. They don't really understand marketplaces or multiple marketplaces, and they're probably more concerned what the commission is. And ultimately, when you look at the quality of the market, I think you have to look at the average order life, which I know Doug could talk to more eloquently than myself. But when an order life is on average sub-second, I don't see how a retail investor can look at the marketplace, see a price, and believe he's going to get it. So my view would be generally no, but sometimes yes.
Okay. Any other thoughts on that? Thomas, thoughts on how the retail investor benefits from all the work you guys are doing?
Is that a question or a... Yeah. Certainly, at the end of the day, it all comes down to retail. Even institutional money is retail. It's there to serve the needs of individuals. And unfortunately, when regulation is designed or policy is designed, I think the term used, to drag them into the conversation, we don't really do that as an industry. We don't really bring retail in the comment period process. We don't really have retail investors go to the IROC or the OSC when rule setting is managed. So the proxy for their voice is the businesses that are supposed to serve them. But they're commercial enterprises, so they're not necessarily speaking for retail. And would I say that you should always think about retail? Yes. I don't think the other constituencies are preventing that. I think that's a failure of the process itself, that it doesn't actually say, maybe we should poll 1,000 retail investors before we change a rule. I think that's valid to do that and to consider what the retail investor would want. Without retail, none of us would be in this room. Mm-hmm. And we have to remember that. And if someone were to say to me, we should change this rule and it'll have this 10 or 20% negative consequence on your business, but will double the retail investment interest in the marketplace, I'd say that's a good thing on balance. And those are the kind of trade-offs that markets and regulators try to make is trade off those costs and benefits amongst constituencies. And I think that there is an argument to be said retail has been left a little bit behind, and we need to bring them back into the conversation.
Rizwan, how are you addressing that? How are you bringing them back into the conversation?
Well, the biggest thing for us when we look at retail flow, one of the common themes that we hear from high-frequency proponents is that they're basically narrowing spreads, adding liquidity, and which for the average retail order, given that it's so small, that probably makes sense. There is an explicit tangible benefit there. However, the bigger picture there is one of integrity of the markets. So one of the things that we basically try and educate retail investors in are some of the benefits of what goes on in the marketplaces, the complexity that's added. What is the purpose of that complexity? Right? There's no point in adding complexity for the sake of complexity. There has to be something there tangible for the retail investor to take advantage of. If you lose that integrity in the marketplace, it doesn't matter how tight the spread is. It doesn't matter how much liquidity there is on the quote. If a retail investor does not believe in the fundamental quality of the market, they're going to pull out. And once they pull out, to Tom's point, we don't really have a functioning market at that point. So things like when they hear about front page news of flash crashes, HFTs making billions of dollars, other scandals. That's not good for the marketplace as a whole. So we need to do a better job of making sure that the complexity is managed and well transmitted to the retail public.
Mm-hmm. Now we have and Doug, I'll give you a chance to respond to this, but just to follow on what you've said, we do have a market-making system in Canada on the Toronto Stock Exchange, and a lot of those people are dedicated to helping the retail investor. Do you think that the front page, the flash crashes, all the rest of it, overwhelm that, and we have to do a better job of explaining what the traditional market maker does?
Yeah, absolutely. I mean, the average retail investor is not really, a student of market microstructure. In fact, I would argue the vast majority of even participants are not really students of market microstructure. So the only sound bites that they're getting are, the front page of Globe and Globe Mail. When was the last time Globe and Mail ran an article on, the benefits of market making? Mm-hmm. I can certainly, just in the last year alone, pick out a number of articles that pertain to mini flash crashes or various things that go wrong in the marketplace.
Mm-hmm. More fuel for the ads, is that? Doug, what are your thoughts?
Yeah, I think that the retail investor, to Rizwan's point, is a little confused with what's going on in the marketplace. And we do have to do a better job of explaining what's going on, but we also have to do a better job of deciding why do we have the complexity we have. 90% of all volatility within our marketplace, so sudden moves in any given stock, are now unexplainable. That number just 5 years ago was less than 40%. So the number of quick, short-term moves in a single stock that cannot be explained by news on the tape, either on the stock itself, in the sector, or at a macro level, is now 90% of the time. If you can't look back and say that stock moved 20 cents, here's why. Suddenly there's a loss of continuity within our marketplace. There's a noticeable loss of confidence. And it's the retail guy, it's the institutional guy. And I'm not saying, and Thomas would like me to say that our market is broken. I'm not saying that, but what I am saying is investors are confused. When you're confused, when you don't understand something, you're going to move into different asset classes, or you're going to trade less often. You're going to participate at a lower level, or not at all. And that's where our market is. Sure, we have tighter spreads, but you have to cross the spread almost always now. The average retail guy is crossing the spread 90% of the time instead of 50% of the time 4 or 5 years ago. That's where our market is. So you tighten the spread, but you constantly cross the spread, you're not doing any better. And the regulators have taken it a step further by taking out things like dark pools that were meant to give you a chance to actually capture the passive side of the quote. They've done that without the data analysis they talk about. They've done it without any evidence that there's any harm. They've done it despite the fact that our market actually sees more transparent trading today than it did 5 years ago. We now have 80% of all trades go up in a lit market as opposed to 50 5 years ago. And we're going to take away that refuge, despite the fact that the lit markets have this unexplained volatility. They have this massive confusion. They have a crowding out on the quote. They have incented people to bid on stocks like Bombardier and Lundin, where we don't need to incent. If you want to have market makers who are making markets on Loblaws, that's terrific. Why we're incenting people to make markets on the most liquid ETFs or the Bombardiers of the world, it's beyond me.
Well, you said earlier in your comment, you referenced to the environment 5 years ago. So I'll ask you, when I think about it, and I think about it in very simple terms, we have more participants in the marketplace, more technologies, more educated as far as market structure. Not perfect, but certainly people understand it more. It seems to me it's better today. I'm going to say that people understand market structure less, and you yourself earlier today said you just put your trade in, you went to the hockey game and you had your wine. Nowadays, the guy sitting in that same seat that you used to sit in has to spend hours trying to understand market structure, and he still doesn't.
I think he was playing golf, by the way.
Oh, it was playing golf.
He was playing golf. Sometimes hockey.
Okay.
Yes.
So it was playing golf. The guy nowadays can't afford to be playing golf, and he's taking time away from understanding what company management is doing or what the fundamentals are of the company to understand how the marketplace actually works. He can no longer say, I want to buy 200,000 XYZ, just go buy it. He now has to understand how to buy that.
Yeah, it's an interesting way of putting it. If I were your client, I'd actually like the fact that you were working for my business. So that's probably a good thing, again, that you're being forced to analyze the market, forced to understand the market, and come up with explanations rather than take the order, put in the order, and go golf and come back and collect the commission. So I think that's a good thing.
I'm not sure I said I wasn't working in the past.
I think
you keep putting words in my mouth. I didn't say I wasn't working in the past.
It was the royal you, Doug. So the idea of complexity, though, is driven by these very comments, right? Where every time we try and solve something, we create more problems for ourselves. And again, I mean we as an industry, you as an industry. So, for example, Riz made the comment around market on close and odd lots. Well, how would you explain that to a retail investor? Let's say we try to ban co-location or create new regulations around co-location. Well, any rules around that would, by just by natural happenstance, also be very complex. And then we would want to create new rules to solve those complexities. So it's somewhat of a never-ending cycle of we want to solve a problem, we create new problems, and then we want to solve more problems, and then we create more and more problems. But what can't be done is you can't roll the clock backward. The world is automated, it is electronic, it is computerized. People are very comfortable with the use of technology and tools. You can't really say, we're going to slow the computers down or we're going to stop access, we're going to bring back the human element, because somewhere else in the world, they're not doing that. And what I would have wanted to say early in the conversation is, what problem are we solving for? We need to decide what kind of marketplace we want. Do we want it to be vibrant? Do we want it to be healthy for our issuers? Do we want people to be able to participate in that? And do that on a globally competitive basis. We cannot make decisions in Canada independent of what happens outside of the world, as much as we'd like to do that. So another driving force of complexity is the international environment we live in. And that's just a reality.
So the question, what problem are we solving for, is an excellent one. When we move a marketplace from 1.7 milliseconds to 400 microseconds, what problem are we solving for? How many people here are saying, boy, I had to wait 1.7 milliseconds to get my fill? I'll tell you what, there isn't a natural investor in the world that cares about that 1.7 milliseconds. There are a ton of intermediaries, a ton of guys who are trying to get in front of your order, a ton of guys who are picking off signals, and a ton of guys who are creating the very volatility that cannot be explained. But there isn't a natural investor in the world who cares about that 1.7 milliseconds.
Well,
what problem are we solving for?
Fundamental theories on efficient markets require intermediaries for those natural investors to meet, and those intermediaries will simply go elsewhere. So, yeah, it's it's kind of like the Formula One analogy, where does it solve anything if everyone goes 10 miles an hour faster? At some point, you have an Ayrton Senna issue. That was a tragedy. Do things happen? Do mistakes happen? Yeah, they will. But the solution is not to stop doing it here and see it happen in the U.S. We've already seen our interlisted market share decline. I believe in 2006, 2007, a lot of the policies that TSX was putting in place, you saw a resurgence in the interlisted market share had gone from about 45% to 60%. It's back down to 40%. If that number gets down to 10, 20, 30, we're not going to be talking about how fast our markets are. We're going to be talking about how relevant our markets are. And the primary concern ought to be to maintain the relevance and vibrancy of the Canadian capital markets.
The reason our interlisted volume is so low compared to the U.S. is because they have higher levels of intermediation, higher levels of HFT, and we shouldn't worry about volume. We should worry about liquidity. And as long as liquidity stays in Canada, our marketplace will be fine. Thank you.
Well, I think we have a comment or question from the floor that may clarify all this for us. Do we have a microphone?
I actually don't need a mic. Thomas, you've implied exactly what I was talking about this morning. You effectively implied that if we in any way, it's a binary decision, right? Either we go back to sticks and stones and the old market makers, or we have this system. We can't question anything in between. I don't understand. So today, TSX continues to have the highest take fees anywhere in North America. Highest anywhere in North America. Should we not be looking at things like that? Should we not question the current system? Does it have to be binary?
The point is that we do question. We do question every day through our market actions. That is what makes a free market. You have a choice as to what you do. If you think it's too high, trade kayaks, trade Omega. But the market has spoken that on average, maybe at the margin people are complaining, but on average, Omega's not getting the share.
I've got to go get it. Okay, and I can go to Select and get 100 shares, or I can go to Omega and get 100 shares. But if I want that liquidity on the boat, I've got to go get it.
So you're a price taker?
Absolutely. But why should someone be compensated to the tune of 35 mils to take that liquidity?
And I guess our point would be just that you have choice, as Thomas has said. You can come to Select for 2 mils, or you can stay on the big market for. But Ian's got something to add as well.
And to be clear, it's a split compensation. Only part of it goes to the TSX.
Exactly.
If it wasn't 34 mils, would that liquidity be there, or would it be? Why is it there in the first place? You see, the argument would be that it's at TSX because of those rebates.
So great question. But so look at Australia. They use a basis point model. Have we even talked about or debated whether a basis point model is as good as a Mills model in Canada?
And that's why I would go back to fundamental. Australia's a great example. An economy very similar to ours, natural resources, energy, booming trade with China, strengthening currency, similar type population size, education, development. Their capital market is nowhere near as developed from a market cap, number of participants around the world, competitiveness to the U.S. versus ours. I would take the Canadian capital market any day over the Australian capital market, and I think the exchanges and the regulators have done a fine job of keeping it that way.
Just one point to add to that on the flip side of it. I mean, to Steve's point, I see what you're getting at. Why does it have to be binary? I mean, so by your own admission, you were saying that, Tom, you did mention that there is an increasing amount of our volume that goes south of the border. Now, if you look at their rebate models, even at 20, 30 mils, if you look at the average price of a stock in Canada is in the ballpark of about $18, maybe $20. In the U.S., it's about $40 change. Now, given that in terms of basis points, the rebates over there are far lower, they seem to attract a whole lot more liquidity. I mean, by your own admission, you're saying that there's more.
It's one of, not the only factor, right? So we were talking about speed at that point in time, right? And I don't think the decision is binary. The point is, our actions every day in minute ways adapt the market structure. I think there's an individual in this room that exemplifies that. Peter Erglis in the back row has been in the business, I believe, 43 years. Recently announced his semi-retirement. We should give him a hand after this. But he's adapted from what you characterize as sticks and stones. I wouldn't characterize it that way. To a market model of today. And he's going to tell you that he can make money trading TELUS without being the RT and against the HFTs. If he can do it, the rest of us can too, but he's focused on it as a business. That's what he does. I think what we're talking about here is the market and the world are super competitive, and you've got to be very good at what you do, or you're not going to be doing it anymore. And this is just a natural force of hyper competition. But people can adapt, and they do adapt.
Ian?
Well, my question is really directed towards you, Thomas. I'm supportive, as most people know, of your views. And I want to make two observations to go in. One, and Stephen, it's not just directed solely at you, but the number of times I had to listen to people profess to be worried about make-or-taker model and profess that the costs were so high, etc., only to see that same firm, when consistently given a choice on the preferencing of their routers with equal amounts of liquidity would be sufficient to satisfy the order and at the same price, they would never go for the low take fees. They go for other reasons, to Alpha or to wherever they wanted to go. And they consistently voted with their dollars. And that their routing patterns have illustrated it. So it kind of falls in deaf ears when I hear a lot of it. Stephen, not saying you per se, but I've heard that.
I'd like to take...
You had the thing, I'll come back to it. The other thing is retail.
There's a couple of seats up here.
Everybody loves... you guys always love... a lot of people always like to champion the retail cause. And they use that as a mask for what their real issue is, I believe. And one thing I've noticed is that while many of us in the institutional business have our theories, very few of us have actually gone and done a lot of high-volume order flow as a retail consumer. I, for example, never had until last fall when I had to unwind an estate, which had about 80 different lines, quite a few $1 million. I spent the better part of a week using your Rizwan, your BMO investor line. And it was fascinating. As the level 2, the depths getting executed, I could tell some of them were obviously coming from yours or some from Alpha with these obscure like 4 decimals or whatever, but I didn't care because I got really good prices. I actually did really well, Doug. I wasn't getting jammed because I could see the depth and play with it, no problems. And so I come back to, every time I've heard people saying, oh, it's this problem or that problem or it's too complex, you know, Thomas, maybe you don't want to agree with it in public, but I think it's really, ultimately what we have to do is look back and say, just why? Who's complaining and why? Is it because of people who are finding themselves disintermediated, who no longer have big fat spreads, who no longer can get in front of their clients like they traditionally used to do, and who now have very efficient foreign competitors coming in and eating their lunch, and they don't like it. Is that what the real problem is? What do you think, Thomas? Is that a big part of it?
You know, Ian, as probably the earliest critic of HFT in this country, and not all HFT, but some factions of it, and sitting at an agency-focused dealer, I can tell you it has nothing to do with guys getting in front of my prop desk. It has to do with the costs that have been driven by the marketplace. It has to do with the fill quality that has been driven by the marketplace. It has to do with the crowding out of the spread. And the reason, quite frankly, that people didn't preference Pure instead of Alpha or the TMX is because the liquidity was not of the same natural flow, and because we saw higher adverse selection, and we continue to do so. We do significant adverse selection, and we find that when we trade with you, it is a signaling trade and leads to higher volatility. And while you do offer a better price, the overall execution quality was poor, so I would commend the dealers who didn't go to the cheapest venue, but actually went to the venue that got their end client the best quality fill. And Stephen, well done.
So I'm gonna answer Ian's question in a roundabout way. But
that was a question.
It was a question.
I didn't hear it.
In 6 parts. This as an industry, we like to stigmatize behaviors. So we use terms like flash crash. We use terms like dark pools. We like people will look at things we don't understand and create a stigma. We don't actually necessarily look deep into what the behavior, what the true economics are that's going on. And I think if you actually poll the room right now, we can't even define high frequency. So when someone on this panel is talking about it, people out here think that they're talking about something that they're in agreement with, when in fact they might be on totally opposing different views, but we label it as something demonic, and we say that it's a bad thing. I'm kind of a little bit farther away from these issues right now, so I take the big picture, and I think on a big picture basis, things are healthy. They're not that bad. If you want to go to the market, you can get a quote anywhere. 15 years ago, I remember you had to go through the newspaper when they had those things, and you had to look at quotes. And they were like a day old or 2 days old. Now you can get them online on your iPhone, real live quotes. I think Eric Sinclair's done a good job of building the data business at the exchange. People can participate in the market, whether it's online, through direct access. On average, over a long-term basis, we've made some significant improvements. And I'm not going to argue over the last 300 microseconds. I don't know if that's good or bad. I don't have the math skills to tell you if 40% is explainable or 90% is explainable. To me, I really can't explain any of it from a market behavior perspective, so I'm a price taker. I go to the market and I'll take what Peter gives me on TELUS. But I do think on a large base in the long run, we have a healthy market, and if we continue to demonize it, we only hurt ourselves because we tell the foreigners, we've got problems here, don't come here. Well, I'd like to see an industry that is proud to be Canadian and proud to go out and bring people to Canada. And for me, the biggest part of the boom the last few years in what some people would characterize high frequency is the volume of participation that happens in Canadian capital markets from outside of the world has undoubtedly increased by significant leaps and bounds. I think that's a good thing. It's good for our country.
If nothing else, it's a terrific soundbite.
I think one thing I should mention, and it is more than a soundbite, and we used to joke that there was something wrong with our phone system at Toronto Stock Exchange because we were getting our return calls 3 years late. But what had happened was, as we saw momentum, as we saw interest in our marketplace, the people that we had laid the groundwork with years ago started to say, hey, that's interesting, pick up the phone, start calling. And, of course, that helps not just the exchange, but it helps hopefully everybody in the room. So success begets success, liquidity hopefully begets liquidity.
But let's not forget that the reason they come here is not because of our market structure. It may disincline some individuals. They come here because of the products we sell.
Right.
They come here because of our issuers. They come here because of your focus and your very distinct focus on commodities, although obviously there are other areas that do quite well. That's why people come here. It's not because we have multiple exchanges with very few listings other than the TSX and Venture. It's not because we have multiple ATSs. People don't come here for that.
Yeah, I think I would agree with that fully, and I say if you just take a quick look at Brazil, although Brazil is going down the path we have gone down, they don't have multiple markets. They have a fully integrated vertical, which is a terrible idea for any exchange, but they still attract people. Why? Because they've got a thriving economy, because they've got some terrific energy and mining stocks, and because they have the very infrastructure that people want to invest in. That's why we think you guys do a fantastic job on the venture market. You do a fantastic job listing that Colombian miner or that Peruvian copper company. But they're coming for the stocks that we list. They're coming for the services that we offer. I fully agree with Andrew, 100%. And I think we do that terrific. We do that better than any market in the world, given our size and weight.
Well, I appreciate saying that. And there's no question about it. It's the infrastructure that makes it worthwhile for an investor to come here and gives them the confidence. I think we take a lot of credit at the exchange. We work very hard to try and bring these companies on, but obviously it's the lawyers, it's the accountants, it's the brokers, it's the banks, everybody coming together. We've built a great system in Canada. But you mentioned, Andrew, that they also come for the products. What are the new products that we can help investors use to navigate this increasingly complex environment? What are you guys working on?
The other people I think we have to congratulate in Canada are we have great engineers. And so while we focus on the marketplace and what the marketplace can bring together, whether they're lawyers, bankers, a large reason that Canada does so well in commodities is our incredible engineering talent. Mm-hmm. So if I look at that and I consider where we could go next, we need to retain and build talent. Mm-hmm. I was surprised to hear the statement on technology, perhaps not quite surprised on clean tech. Mm-hmm. I think we've got to focus as a country on ensuring that we educate our children and that they grow up and they have something worthwhile that can create industry and not just see technology industry be boom bust. Mm-hmm. I look at where we find ourselves with research in motion. And it's a very concerning situation when you consider how many companies in and around that listed corporation are supported in the Waterloo area. So I think when we're looking at Canada, we can't overemphasize education. We can't overemphasize bringing in educated immigrants. I think it's very important that Canada figures out how to build a solid manufacturing base and a technology base.
Mm-hmm. And then just to add to Andrew's point, I think one of the other things that maybe perhaps the Canadian markets need to focus on is diversifying our issuers. Like right now, we're extremely concentrated in the three sectors: financials, mining, and energy. That because of the downturn that we've had in the resource stocks in the last 6 months or so, TSX or the Canadian indices have lagged the U.S. indices just precisely because we are so concentrated on those sectors. So to get away from that, we basically need to try and foster other types of industries that come to Canada, maybe perhaps get those listings coming over and not just resource and energy focused. I mean, we have an amazing creditworthiness as a country. Like, issuers, for example, in Europe would rather trust coming to Canada than some of the countries within Europe themselves. So why not let's go after those listings and bring them over to Canada and leverage the goodwill that we've built up over the last few years to expand our markets.
I think it's a great point because the commodity story is often a door opener. We'll go say, and you've heard about us. You are interested in commodities, but here's the rest of the story, and can we attract you across? But you're also doing a lot of work in ETFs and diversifying there. Is that you're obviously seeing great success there? That's something you're building on, or are there any other products that you guys are focused on you'd like to tell the group about?
Yeah, I mean, absolutely. The ETF story has been a success story at BMO. As you know, we've now got a franchise of ETFs that we've built over the past few years. We are gaining more traction in that space. As the whole marketplace as a whole, the AUMs that's actually benched to under ETFs is growing. It's definitely a place that I think more and more participants need to be in. We need to understand how ETFs work. We need to understand how they trade, what the mechanics are. Behind the scenes, because even though it's fairly straightforward, if you think about an equity ETF on how they basically trade behind the scenes, some of the products that are coming out now are far more complex than a simple ETF to many stock type of deals. You get ETFs that have all kinds of things behind the scenes that we need to do a better job of educating the marketplace. But certainly, like I said, it's something that is gaining traction, and going forward, I think it's only going to be a growing part of our industry.
Right. Certainly, when we visit international investors, that's often what they'll say. Obviously, not the United States, a very good knowledge of our market. But when we go further afield, people will say, well, tell me about the ETFs. That'll be my toe in the water. But Doug, what are you guys working on?
Yeah, I think ETFs. I think as we're looking towards, Volcker Rule is coming faster this week than it was last week, thanks to the fine folks at J.P. Morgan. And as a result, we're looking at a world where we're going to see a disintermediation of what I will call real liquidity providers, and those that stand up with real size and don't run away 10 seconds later. As the big banks get away from making markets on those, we're going to see new participants, and we're already seeing it in the U.S. We're seeing guys like Bluefin and Jane Street and Susquehanna step up and provide that liquidity. But somebody needs to package that liquidity together and aggregate it. And I think the aggregation tools and working with clients to understand where it is and to show them how the creation process is better than the purchasing process at some times, and at other times you want to trade within the market. So I think there's a lot being done in the ETF space to understand what the products are, to help the regulators understand what products are good and where we're going off the deep end with some of the collateral issues and some of the swap-based ETFs that are suspect, particularly in Europe. Understanding where the liquidity is going to be provided and bringing that together and creating one platform where people can trade, whether it's fixed income, currency, commodity, or equity ETFs, and be sure that they're getting the liquidity that they're looking for in one spot. That's really where our focus is at the moment.
Makes sense.
Yeah,
Thomas?
we actually see the future as more from a services perspective rather than products. We think there are many financial innovators out there developing products all the time, and in our business, we think there's a lot of value add to bring participants together and educate them on how to put these products together and actually add value. And I actually do think that many of these international investors are here because of the market structure products that have been launched, whether it's multiple ATSs, the co-location, those types of things that TSX and others have introduced. I'll give you a real-world example. Let's take that Peruvian mining company that listed on the TSX is being traded by an Asian investor and using our equity finance department that's basically doing collateral downgrades or upgrades from a UK pension fund. And all that's global activity, but the service and the value is coming here into Canada, and it's paying very well, and that's very valuable for us. And those are very good jobs, very well-paying jobs. And I think that's the future. That's what we're focused on. And we think more openness, more participation only creates more opportunities to stitch all these products together in services and continue to provide these opportunities for people.
So that UK pension fund wouldn't buy that Peruvian miner if we didn't have co-location?
These are all things I think that it's the whole infrastructure, I think is what Thomas is saying. Can I,
Sure.
Any questions on the floor? Or ask out here? We do have.
Hi there. Thank you very much for talking about ETFs. I'm a little biased, but I guess that comes from the complexity question. Does the complexity go greater with the Maple transaction? And if you are part of the Maple transaction, would you want to be on that deal? And I think from the viewpoint from Doug and from Thomas, I think you'd have two different viewpoints because the complexity would probably change your view as to where the trading is going to happen going forward.
So to just be on the record, I did not bring up Maple. Lewis brought up Maple. I'm guessing Thomas isn't allowed to respond on Maple. What I will say in short on Maple is impossible to say whether Maple will make things more or less complex, because for those of you that listened in on the TMX earnings call last week, it was made clear that they have not decided whether we will have as many markets, more markets, or fewer markets as a result of this. We don't know if it's going to be more or less complex. I think the corporate governance around it is going to be more or less complex, But hopefully that'll be behind the scenes and will not be transparent. It will be transparent to investors, but it won't be of a concern to investors where they'll have to understand it to invest in our marketplace. I don't know if either of you guys are allowed to.
For the record, Doug gets the only word on this. I cannot speak to the Maple transaction.
I'm in the same boat. Yeah, being TMX's bankers would have no comment.
So I'm more than happy to talk about it.
All right.
We could spend the rest of the panel on this.
We could. So, my view is that the Maple transaction itself likely doesn't have any material impact on market structure or complexity. Because the reason we have complexity, to my view, is more because we have some anomalies in Canada, and it really goes down to data royalty and venues being able to charge for data when in any other country an ATS is generally not allowed to charge for data royalties. And that data royalty charging for a very small participation in the marketplace funds this overly complicated environment we find ourselves in, where there's de minimis trading really occurring in many venues. And those venues without the data royalties, in all likelihood, would struggle to survive or to have any reasonable business rationale to be in business. If I look at the Maple transaction in its full breadth, rather than just marketplace execution and marketplace structure, if I was the TSX, I would love to be vertically integrated to CDS. My biggest concern, our firm's biggest concern, is really the change of CDS from a not-for-profit organization, where we have seen advantages, where they have proven to be relatively efficient, that they're relatively cheap compared to all other comparative clearing settlement depositories other than DTC, which is the largest in the world. That would be my biggest concern. Is it's not the marketplace structure. It's not does Alpha stay around, does Alpha not stay around. It's the implicit integration of CDS to a for-profit, slightly adapted model, depending on what the regulators push through. So those would be my key concerns. CDS.
I'm also not allowed to comment on Maple, but I will thank you for your comment on data. So can I call from the floor any other questions? The last question before David?
Thanks. So one of the impacts of the new dark liquidity rules will be a significant increase in the cost of trading for market takers. When we look at take fees in Canada versus take fees in the U.S., the total value of take fees is almost 4 times higher here than it is in the States. So one of the risks is that we'll see flow migrate to the U.S., and a reaction by the regulators is to introduce anti-avoidance rules to ensure that Canadian investors can't access U.S. markets and can't trade in U.S. dark markets, which represent about 37% of that market. So what are your thoughts on the long-term impact to the Canadian market of introducing anti-avoidance rules, given that we are trying to be an open marketplace?
I think one of the things that we will see, personally, I don't think that will get passed. It just seems so incomprehensible that we would have that kind of a barrier in place. But assuming it does, one of the things we'll see is likely an increased implicit cost of trading. As spreads widen ever so slightly, it brings in interlisted arb back into play. In this day and age, with high frequency trading going on in Canada, interlisted arb is not a very, very lucrative business. The margins are very, very thin. Once you bring those anti-avoidance rules back in place, spreads widen up. You're basically essentially paying an interlisted arb to function and take that liquidity on your behalf in the U.S. markets, and paying a small fee for that. So the cost of trading will go up.
Yeah, I think I would agree with that 100%. We talked about retail earlier, and the fact that the regulators have, for whatever reason, decided to make Canadian retail flow effectively captive to the Canadian market, where they're going to get worse price because of the complexity of the rule and because the U.S. marketplaces don't have order types necessary to manage the rule the way it's being put in place, means that they will trade at worse price in Canada. They will have less access to liquidity compared to a U.S. retail client or a Canadian institutional client sending an order on the same stock. I've never seen a regulator produce a rule that's going to actually make the retail client get worse access to liquidity and get a worse price. It's confusing. The technological implications, despite what it says in the comment letter about there being none, are actually vast and incomprehensible. And the manner in which this rule was brought forth and proposed by the regulators was done with limited consultation, and they clearly did not listen to the constituents in the marketplace. So I'm surprised this is coming forward. I don't think it will pass. If it does pass, I doubt it'll last long, because I'm fairly certain that the data will show fairly clearly that order flow is drifting to the U.S. and that the Canadian retail client is getting harmed seriously.
So I don't necessarily believe that. I certainly think there's a likelihood that we will see symptoms that will be like that. It's certainly an interesting experiment.
But if I have a large order, Andrew, and I can slice it into 1,500 shares and trade it in a U.S. dark pool, but I can't take a same 1,500 share order for a Canadian retail client.
I realize the anti-avoidance issue is a real concern. But I think what it does is, it doesn't make it more complex. It actually makes it a lot simpler.
It makes it simpler. I just can't trade in the U.S.
It makes it simpler insofar as it's not 10%, it's not 20%, it's midpoint or 1 MPV. So
Sure.
That's actually a greater simplification. And I think what it does is it takes some of the concerning flow we would see in some of the dark pools today, which would be somewhat, I would view them as being somewhat toxic for a 10% lift or, at most an MPV. And so it will be interesting to see whether that will actually incline the institutions to spend more time trying to grab liquidity at midpoint.
That said, any order over 5,000 shares on the Lundins, the D2Goals, the Bombardiers can now trade at the touch. So you're actually going to see greater dark pool participation at the touch. For the first time, we've never had at the touch dark. It hasn't been allowed. Now we're going to allow it. It's going to thrive. And so you're right on the smaller orders, but it's on the smaller orders that, that's the retail client we keep saying we're concerned about.
Thomas, the final word to you.
I'll pass on that one.
With that, I will ask you to thank the panel. Great job.